You're listening to the Multifamily Mentor Show.
My name is Terrence Doyle.
And I'm Chris Lopez. You probably know us from the BiggerPockets Real Estate Ride Along Show. Well, now we're talking everything multifamily. We bring in top industry experts from around the country to come join us in our Denver studio for an in-depth, in-person conversation.
We're going to be diving deep into deals, underwriting, raising capital, and everything in between. Join the conversation.
Hey everyone, welcome back to another episode of the Tribe of Multifamily Mentors here at BiggerPockets. Chris Lopez here with my co-host Terrence Doyle. Terrence, how's it going today, my man?
Super well. We just had a great Q&A with our awesome guest here, Steven Pesavento. Super excited about the show.
Yeah, Steven, glad to have you here, man.
Yeah, I'm excited to be here, you guys. This is really fun. Loving the new studio. Loving it.
Yes, it's going to be a lot of fun. So let's jump into some questions here, Steven. Terrence, you got the first question to tee this up.
A little background on Steven, just from my personal standpoint. I met Steven maybe 4 years ago. We were at a coffee shop. I knew him as a house flipper. He was doing flips in Minneapolis, North Carolina, living in Denver, and was talking about launching a podcast, getting into multifamily, and we were just brainstorming. We were at a coffee shop on Tennyson Street, brainstorming ideas, and I left, and I was like, man, that guy, he's going to do something, and definitely someone I want to stay in touch with. Here we are, 3 years later. He's launched a super successful podcast. He's got
the Investor Mindset podcast.
Yes, the Investor Mindset. He's going to go into talk about that. He has launched a capital sourcing company, Von Finch Capital, sourcing capital for a bunch of multifamily deals around the country. And I really have been impressed of how he's pivoted from house flipping to what he's doing. So I'm really excited to talk to him. And I think my first question for Steven, because he has a great story, is I really want to know how you got started in real estate 5-6 years ago. I know you were living in Southern California. You were a consultant. Tell me how it went to get into real estate full time. I got to know.
Yeah, so I was just kind of like so many other people who are listening here on BiggerPockets. It's like you have that feeling, you want to get into real estate, you're really excited about it. You know, like the possibility of what it can create and all those things, but there's this fear. And for me, it was this like limiting belief that kept stopping me right as I felt like I was about to make some progress. I'd make an offer, it wouldn't work out, I wouldn't continue going on. And so, you know, at 17, at 21, had made offers, was looking to get in. But when I finally stepped into it, it was getting over that limiting belief of not knowing, you know, how to do this, not having the experience, not having the capital, not having the background or family, or being the person who believed they could go and do this. And so when I finally decided to jump into the business, I really took kind of a unique way of getting in. I knew I didn't have a lot of money. I was in a position where I was earning well, but, you know, kind of was in a position where I didn't have that much capital in my bank account. It wasn't like I was already super rich and I was going to start into real estate. That was like one of those limiting beliefs that was kind of holding me back. So when I decided and I made that decision, I remember specifically jumping up off the couch, looking at my girlfriend at the time, and just telling her, like, I'm doing this, I'm moving forward, and I decided 100%. And it was in that moment that everything changed. And because all those other times before, I had just a fear of actually going out and doing it. And I still had that same fear, but because I decided, I knew that I was going to step into whatever was going to come and just kind of go with the flow with that.
So fear's like a trigger word for a lot of people, you know, especially coming out of this pandemic, and just there's fear everywhere. So walk me through like where you think that fear came from. Like, I really want to understand, like, what was the fear out of? Like, because you didn't have a lot to lose. So it wasn't a fear of like losing more, I'm guessing, but like, what was it? A fear of failure, your parents, your friends? Like, can you unpack the fear a little bit so the audience can maybe relate with you or think about maybe their own fear and where that comes from?
Yeah, absolutely. I mean, it's one of those things where, yeah, I maybe didn't have tens of thousands of dollars that I was going to lose in a specific deal, but you can actually lose money you don't have. You can go into debt. You can owe people money, or, you know, have a deal that fails that puts you upside down. And so there was that fear. There was the fear of, am I the kind of person who can step into this and do this? Do I have the skills? Do I have the relationships? And to what it came down to was a mindset piece. It was the identity. I didn't have the identity of a person who was going to be able to step in and be a real estate investor until that moment that I decided that that was going to be something I would do. And the thing that ended up bridging the gap, the thing that really made the difference for me was that when I made that decision, I made a decision of what action I was going to take. And for me, it was actually finding community, getting around other people who were already doing this, who believed that it was possible because they already had success in real estate. And so I went to a real estate meetup and just wanted to find a way to be surrounded by other people who were doing really well.
So I got two questions for you, Steven. How old were you when you had that jump off the couch moment?
Yeah, 26, 27,
Okay.
going right around there.
And then secondly, I think you're about to go into this. How'd you build that community? Because I totally agree with you, being surrounded by the right people. I think it's Napoleon Hill has that, your net worth is the average of the 6 people that you spend the most time with. How'd you go out and build that community? Because that is easier said than done a lot of times.
It can be, but it's actually what's cool is it's easier today than ever, but there's so many distracting ways that you can go about doing this. So when I decided, the first path forward was I need to meet people in person. So I knew about BiggerPockets, obviously was going onto the forums, reading, engaging with people on there, listening to the podcast, starting to fill my brain full of all these people who were already doing it and essentially taking on their beliefs. I was borrowing their belief that this was something that was doable and that I could then step into that until the point of me being able to have success and own the belief and make that belief mine, right? I'm borrowing their belief. And what ended up happening was I decided to go to this local real estate meetup. And real estate meetups are great because there's a lot of people who have experience and there's a lot of other people who want to get into real estate and they're coming together and they're learning and they're sharing. And there was a specific speaker that was going to be at this event. And so what I decided to do, I'm like, okay, well, I need to learn everything I possibly can about this speaker, and started listening to podcast interviews and diving into her background and understanding kind of her experience. And what I found was that she was a flipper who had done a lot of deals. And even though I really wanted to own property long-term because I wanted that cash flow, I knew that I needed to create income. And I wanted to create it through real estate because I believed that that was going to be the path to have the most success long-term, is be able to build off of that experience and go into bigger things. And so I saw an opportunity, something I asked myself was, how can I be of value to this person? How can I be of service to their mission? How can I figure out a way that I can give to them so that it's a no-brainer that they're going to want me to be a part of their circle? And so I had, gone to this event. I'd done all this research. I didn't know if it was going to work. I had an idea in my head, and I walked up to this person after, waiting until everyone else cleared out so that I could ask my question, and, a little bit nervous, but showing up confident. And I just asked her, I said, hey, I'm really new to real estate. I really enjoyed what you were talking about. And, looking back during the event, I was asking some strategic questions so she could tell that I was engaged. There were smart questions. There were ways for me to be noticed while being present at this event. And so I asked her, I said, hey, I'm new to this. I would really love to learn how this real estate space goes. And I don't know that many people, but what I'd love to offer you is to build you a $10,000 to $15,000 website. I have the skills and experience and the team to be able to do that. I'd love to do that for free. And all I'm looking for in return is an opportunity to talk to you and to be able to ask questions and maybe be able to go out to a property or time or two. And before I could even finish making the offer, her hand was out. She had a big grin on her face. She knew she was getting a good deal, and she was excited because it was an opportunity for her to be able to help someone else. And that in that moment, I realized two things. One, if you're thinking about what other people need before your own, you're going to be in a much better position, right? And the second thing was that other people want to help you. If you look to mentors, it's not a one-way street. Other people are out there, they want to see you succeed. And if you show up as that person who is going to do whatever it takes to succeed ethically and morally, then other people are going to want to help, be a part of you, being on the way up and being a partner versus being maybe some competition.
So pause right there. A lot of people know my background's in sports. I love talking about fundamentals because I think the elite people, regardless of what they do, have all mastered the fundamentals. So a fundamental thing I think that you did there most people don't do. I mean, a lot of people reach out to me, a lot of people reach out to Chris, reach out to you, and they ask questions. They want help. They want to get coffee. They want to pick our brain, understand how to do certain things. Very few people come and say, hey, I want help, and I'm willing to offer you disproportionate value in exchange for the help. So where did that idea come from? Because I think that's something that so many people need to hear to jog their brain about, hey, what is the unique skill set or value that I can bring somebody that's disproportionate to what I'm asking for in return? And I think if you lead with that, I think the results are going to be like ridiculous, off the charts.
Mm-hmm.
But where did that idea come from to approach this woman instead of just saying, hey, can I buy you coffee? Can we get coffee next week? And can I ask you a bunch of questions?
Yeah.
Versus, hey, I love what you do. I really want to get into it. And by the way, I want to offer you 8 times the value of what you're going to give me.
So when you think about when it comes to marketing, when it comes to business, there's an idea of kind of who your ideal client is. And you start to understand what does that person really want? What is going to be most beneficial to them? What is going to be of most value? And so when you can start to think of who this person is, and in this case, ideal client was somebody I wanted to work with in a mentorship capacity or be able to be in their sphere or circle. But I couldn't go in asking the question, do you want to be a mentor to me for free and give me a bunch of your time, and I'm just going to ask you and take.
But I'm going to pay for a $10 coffee.
But I'm going to pay for a $10 coffee, right?
The vanilla latte.
We've all had those conversations with people who definitely come in and you can tell they're only looking at it from their own perspective. But there's a concept where you want to create an irresistible offer, an offer that is so good that it would be nearly impossible for your client to say no to. So in this case, I looked at what does this woman need? She is successful. She probably has a lot of money. She's running a very successful local real estate club, which means she probably really enjoys engaging with other people and helping people. But there's a problem that she's dealing with, and her website looked like it was from 1999. And so through this process, I was able to think to myself, well, hey, an irresistible offer would be, I'm going to build you something that would cost you tens of thousands of dollars for free. And in return, I'm looking to have a couple conversations with you. The disproportionate amount of value makes it almost a no-brainer to get the foot in the door. And when you're thinking about business, when you're thinking about life, when you're thinking about relationships, if you can come to a relationship with that kind of perspective of delivering value, it makes it really difficult for people to say no, right? So that's one of the biggest pieces of advice I have for people is I'm a big believer in paying for mentorship. I pay for multiple coaches. I've been part of masterminds that have made huge differences in my life. But for me at the time, I had a belief that, one, I don't have the money, but I have a lot of time. And I had a belief at the time where I was really afraid of paying for any kind of advice or any kind of coaching and, being able to work my way down. So I looked at what could I give to this person that they can't get anywhere else. And that's what I would encourage other people to do, because you can look at no matter what you do, you've got a skill set somebody else really needs, no matter what. Now, you just got to be able to really reach inside and start to ask the questions to yourself and then test it in the world by talking to, in my case, this woman and asking her a question that she could have said no to. Hey, I'm actually not that interested. No problem. I would have then continued to ask questions to find out what would be of value and maybe come back with another offer, or I'd move on to a new person and look to be of value to them.
And I want to highlight something here, because to kind of just flip the roles here, because you're obviously providing tremendous value to her, you're getting tremendous value from her as well, is that when you're in that position, when you're up there speaking, everyone comes up there and it's just like, not in a bad way, but just take from that person. And it is exhausting. It is mentally, emotionally exhausting. We've all been there, and the more successful you get, the more that is. And so when you come up there and say, hey, I've got this idea and this solution and this idea to add value, it's like, it's refreshing. I'm like, what's your name again? Mm-hmm. Let's talk some more. And so everyone out there, rewind the last 4 minutes or 8 minutes what Steven's been talking about, because that right there is key. I mean, I've done very similar things, help me out, and what Steven's story is just spot on. So that is a great way to add value, but also get value as well, and build real, meaningful relationships.
So let's move on from there. So you offer this lady disproportionate value. You build her a website. She's willing to help you. Take us through what happens next, the next 2 or 3 years that gets you into house flipping, out of state, building that. You end up getting on the BiggerPockets podcast. Walk us through that high-level story so we can move move
Yeah,
the
absolutely. So, as we move from that story, and was able to participate from the beginning to the end in seeing what it was like to work on a flip, the contractors, the conversations, the questions, starting to learn the lingo. And that's really important, because what was actually coming out of that, I received way more value in return by being able to be around this person and build that connection, that friendship, and learn how to do this business. Because then where it really built was continuing to show up in an authentic way at events, speaking to people, connecting with them, and them seeing me every single week or every month. Because I was going to every real estate event I could possibly go to, and there was 4 or 5 of them.
Southern California?
In Southern California, Phoebe, For Investors by Investors, that event in particular. And I would see some of the same people, and they would see the progression. And so when you're a person who's making moves happen and you're clearly eager, and even if you're not at their level, they see that you're really committed, so other people take notice. And one of the other big lessons I learned from that is that if you're a person who's putting in the work and people see that, they want to be a part of helping you, succeed. So if I fast forward, I had gone down the path of, putting in 89 offers on the MLS to get none, to get no deals out of that. 2 were contracted, but they were terrible deals, to sending 3,000 letters locally and getting 15 phone calls and spending half of my marketing budget, $1,500. A lot of lessons learned in there. And that's what actually led me down the path of, investing out of state. So I was living in SoCal, started investing first in Raleigh and then in Minneapolis. And I had went and found somebody, again, through the same kind of idea of how can I be of value to this person, and partnered with them because they were in a position where they were extremely experienced in flipping houses, but they hadn't been experienced in going out and acquiring deals off market. And I had the belief through, some networking, through some coaching, through a community that I was a part of, that I was going to model what they did and see their same results. And so if we fast forward from there, bought and sold 75 houses my first year, flipped 200 houses within about a 2.5-year period, scaled up, 15-person team, spent millions of dollars on marketing, a lot of lessons learned, a lot of really amazing things in business. And then I also got to a point where I was like, is this what I want the next 10 years to look like? Right? Because, it was starting to get a little bit burnt out doing high volume, low margin deals. There's a lot of good things about it, but as the market was starting to change and I was experiencing what that felt like, and what having a loss on a deal was like, or what having tight cash flow was like in a business. And I started looking at, well, how can I continue to scale working out of state? By this point, I'd moved to Denver, started building community and living there, but was still investing out of state. I started looking at, well, I'm going to hold properties, right? And so I started holding a bunch of single family properties, and I started dealing with, the challenges that you have when you're holding on to single families and you have third-party property management, even with a team on the ground, even with our own contractors, even with, a heavy vetting process, and, really being able to go and be present, even though we're out of state. And so I started looking for, how can I find a way that I can be invested in deals, that I can bring all of the unique abilities that I have, all the skill sets, and I can leverage that in a way that I can be of value to someone else, and that my investments are going to be protected by, again, partnering with an operator or operators that are really experienced. And what I found was, in the commercial space in particular, there's a thing called syndication. And the benefit of that is that typically the investors are receiving 80% of the upside on the deal. Sometimes it's 70, sometimes it's 90. It's usually always good returns, but they're receiving majority of the upside while doing none of the work. And so that really, really sparked my interest at figuring out, well, that's an incentive structure where people only are really getting paid, 80, 90, maybe even 95% of their compensation based on success, versus a property manager is getting paid on doing those actions. And that is what ended up leading me down the path into multifamily.
So yeah, this is the Tribe of Multifamily Mentors podcast. So we want to focus on multifamily, although your background's fascinating, how you got from single family, multifamily. So unpack a little bit for me, because you just went over it briefly. So you're flipping hundreds of homes a year, wholesaling homes out of state, having success. What was the light bulb, just like you had in SoCal in 2016, where you're like, I have to get into real estate? What was the light bulb moment where you're like, I really want to pivot and get into multifamily and burn the boats or the bridge on single family.
Yeah, to be honest, the podcast and multifamily were kind of separate, but what was really interesting about it was I obviously having a lot of success in my business. We were seeing a bunch of transitions kind of happening within the market. Things were getting tighter, deals were getting tighter, and I was in a position where I was thinking to myself, we're taking on high interest debt, highly leveraged short-term loans, and if we have another one of those, another 2008 or a recession, we'd be in a pretty bad place if the market turned. So I was trying to think, how can I modify and pivot my business in a way where I can continue to scale in real estate, but be in a position where we're looking from a longer term time horizon. Longer term, in my eyes, equals more secure because it's more time that you have to make changes until you get to the end of that period, right? And so after kind of talking with experienced operators, people who'd been through 2008, firewalking their experience, I was like, I need to make this move. And I went to an event. It was actually the best ever event here in Denver. Joe Fairless puts on an event for multifamily investors, really talking about real estate across the board, but a lot of multifamily operators, high-level operators are at that event. And I had kind of been introduced to it before, and I was already kind of looking at that. That's why I showed up to the event. But I remember specifically having that aha moment of seeing the ability to scale, right? From a guy who scaled from 0 to 75 deals in 1 year and continued that, I thought to myself, well, how could I take that same concept of scale, which scale is good because it ends up, it can be more affordable to operate. You can have better diversification of income coming in on a consistent basis. And how can I figure out to get into that space to be able to scale into larger units that make more sense for me to fly all around the country to instead of, flying to Raleigh and, working on single family houses. But I was really set on this idea that I'm going to live wherever I want, that I'm going to be location independent. And to me, that belief and value is so core. And so that was the moment. It was at that event. I already had decided I was going to do a podcast. I had this clear vision coming out of this event that I went to. And I knew that I had always wanted to do the podcast, but I had those same limiting beliefs that, I don't have the experience. What am I going to talk about? People don't want to hear from me. And then I realized I need to just put my voice out there. I am really good at interviewing people. I'm really good at asking questions. I'm really good at speaking extemporaneously. And I just need to overcome that and step out and step into this. And so I decided to do it. And it was at that event, I met some people who had just started their podcast, but I had thought they were doing it for a long time. And they had just started multifamily. And I was just like, wow, if they can do it, I can do it too. And so for me, the podcast was never about multifamily. It's the investor mindset because I really believe that everything starts with getting in the mind, understanding those thoughts and beliefs that end up leading to the actions you take. And if you can understand how other successful people operate, then you can apply those same things.
I do think you have one of the best voices, and you're very articulate and a great marketing mind. And shout out for using the word extemporaneously or whatever you just said. That was really impressive.
You're braver than I am.
I don't think I've heard anyone else say that on live anything. So shout out to Steven Pesavento for using that word here. And it's been incredible to watch you grow. I love the podcast. I've personally gotten a lot of value from listening to your podcast. You have some great guests, talk about a lot of different topics. And I think you've done a great job. So let's talk more about multifamily. Tell us, through the podcast, some different things that you've learned about multifamily. Tell us about your journey in multifamily, how it's gone so far. Let's talk about multifamily.
Yeah. So when it comes to the podcast, what's great about a podcast and what I encourage you guys to do if you're listening is obviously dive deep into this show and continue listening to more episodes, because when you get to hear all these different ideas, all these different philosophies, all these different ways of thinking, you'll start to notice that there's a pattern, right? A pattern of way people are thinking about this, the way they're doing deals. There's a lot of different strategies, but you just got to choose one and make that your strategy. And so for me in multifamily, I started out thinking to myself, well, maybe I'll go down the path of acquisitions. Maybe I'm really good at marketing for deals. Maybe I can apply that skill set, from going direct to seller.
Which is what we originally talked about.
Was what we originally talked about.
Be able to source deals and I would fund them.
Yeah.
2000, maybe 17, we talked about this.
Oh, was that the original plan?
Yeah, Steve was going to find the deals and I was like, dude, you find them, I'll fund them, but it's hard. And you were like, yeah, I think I know how to find them. That was the original conversation.
Yeah. So as that progressed and understanding more about kind of how larger multifamily works, essentially brokers are banging on these people's doors 100,000 times a day, and they're going with a very different offer, value proposition. Hey, you don't have to take any risk. I'm going to offer you, I'm going to go find a buyer for you that's going to get you $1 million more than the property's worth, and they get their foot in the door. Versus me, I'm trying to buy it for $1 million less than they would list it with a broker, right? So it's a different value proposition. Totally works. People are doing it. But what I realized was after going down and looking at all the different roles on a multifamily team, and when I think about a large syndication, there is, going and finding the deal. So that's building relationships with brokers or going direct to sellers. There is underwriting the deal. So understanding if that's a great deal. Are the numbers, do they make sense? What are some of the assumptions? What are some of the risks that are built in here? Then there's actually operating the deal, and that person or that team or everyone on the team is going to be focused on how do I make sure that we're getting the most out of this, that we're keeping expenses low. Maybe there's a piece of that that's focused on construction, like what Terrence does, and kind of what one of his major differentiators and biggest advantages in the market here is the fact that he's running construction internally. And so that's on the operations side. And then there's the money side of raising capital, of having those relationships with investors, of being able to not only educate and teach people about the value proposition that's available, but also being able to essentially, you're kind of like a therapist. People are going to have fears about investing in general, and you're going to help ask questions, not give answers, but ask questions for them to be able to figure it out on their own. So you're kind of coaching people through the process, not by telling them what to do, but by giving them and empowering them to make their own decisions. And then they decide, do I want to invest or do I not? Are we going to work with institutional money or not? And so as going through all these different roles and understanding where my unique value proposition was, or my unique ability, if you will, I realized that I'm really great at education. I'm really great at building connections and speaking, and I'm really great at building relationships with people. And I really want to figure out how can I add value on a team. And one of the biggest challenges that I think is out there is that when you're getting started, it's always about getting that first deal, right? Once you got the first deal, they start rolling in. There's always that law of the first deal that, it's the hardest one, but once you get one, you can get two. And once you get two, you can get 10, and brokers start bringing you deals and so on and so forth. But for me, what I realized was I wanted to build a business based off of the expertise of others. And I wanted to be a part of a team. Being a single operator, being a guy who's been operating, working remotely way before it was the requirement with COVID, I was like, I want to be surrounded by people who have 10 years of experience, people who've, owned thousands of units, people who've already learned and made all the mistakes so that I can then go be a differentiator and bring value to their team, of being able to join their team, handle investor relations, handle the capital, handle the marketing, and doing those things. And then work with investors to be able to bridge the gap between the two, because some of the deals that we have access to, most people would never be able to find, let alone even know where to look. And so that's where I really realized that was my opportunity. But it took a little bit of time of kind of exploring which of the different paths is going to be the best fit, and then making a decision. Is any one better than another? Absolutely not. But for me, I made this decision to really focus on working with investors and partnering with operators to bring retail investors into deals they otherwise wouldn't have access to. And we can talk more about what that looks like for sure.
So you have a high level of self-awareness, just, figuring out your strengths. And I very much agree with that attitude. What advice can you give others out there for how can identify their strengths? Because I see a lot of times people want to go out there, they see this opportunity, but it's not to their strength, or they try to be the jack of all trades. But you identified, hey, there's this, there's this, there's this, there's this. Hey, I'm good at this, and matched up with like this part of the overall bigger picture. How do you advise people to figure out what their strength is to match up in the bigger picture? Yeah,
it's such a good question. And the thing about it is that it's a process. You keep getting better at it over time. You keep asking yourself that question and kind of keep checking in on two different things. One question I like to ask myself is, what activities or things that I'm doing are energizing me? What is exciting? What is wanting me to get up or get on the phone or get out of the house or do different things? And which ones are taking energy away? Which are things that I'm naturally wanting to avoid? And which are things that I'm not taking action in doing because of some feeling or belief or fear that might be there. Now, let's work through those beliefs. Let's work with a coach, a mindset coach. Let's work with, therapists, professionals to be able to uncover the psychology so that we can step into, being an elite operator, an elite investor, but at the below the surface, everyone knows what they're good at. And if you don't, go ask people around you. So when I first started, I would, go to friends or family or maybe somebody that I knew through a work relationship. I'd be like, this is going to seem kind of like a really strange question, but I'm wondering if you would be open to doing me a huge favor. And then they're like, oh yeah, for sure. What is it? And then you're like, well, I'm wondering if you're comfortable. Would you be comfortable being really open and honest with me? And maybe even to the point where you might say something that might hurt my feelings. Yeah. And if you're kind of like, you're setting the stage for them to be, it's okay for them to tell you stuff that might hurt, but they're also going to tell you stuff that's going to really be clear. And so through that, asking those questions, you start to realize like, oh, you're really, really good at this. And most people don't tell you like bluntly what, the things, because people are naturally, they want to, maintain a great relationship. But when you do hear those little nuggets, or you hear the things that you're good at over and over again, you start to identify a pattern, Yeah,
I love it. That's really well said. And the self-awareness piece is huge. One of the things that stuck out to me was that when you're asking people to try and identify what your strengths were, is you let them take down their guard and let them know that it's okay if they were going to say some things that maybe they had been thinking but didn't want to offend you, so yeah. I think that was huge. Yeah. And I think back in the day, like maybe 2008, 9, I forget what I had listened to, but I actually did the same thing. I called like the 5 people closest to me and said, hey, what are the 3 things that you think I do best? And what are the things that I'm not good at? And I didn't really articulate as well as you just did, but it's the same thing. It's like, in order to know what your strengths are, you got to call 4 or 5 people that are really close to you, and they have to know that it's a safe place. They're not going to offend you, and just tell you, hey, here are the 3 things I think you're best at. Here are the things I think you should not touch. And since then I've had like great clarity on here are the things that I should focus on and not. But having people that are close enough to you and know that it's safe enough to not offend you, to tell you those things, I think is huge. And the way you said that, I really appreciate. So I think people out there listening, that maybe if you don't really know your strengths, go back and listen to that, because the best way to find out is call or email or text. I don't even know, like Snapchat, Snapchat, Instagram, DM, whatever the things that, the way you communicate with people closest to you, but do that with people. Yeah. Say, listen, this is a safe place. Take down your guard. You're not going to offend me. You can say whatever you want. I want to know what I'm good at. What are you, in your opinion, what are the things that I'm best at? What are the things I'm not? And take those things, Gary Vee style, double down on your strengths and find people to either partner or hire around you that are good at the things that you're not. I love how you articulated that. That was really well said. And I love that. And I think there's a lot of value there for the audience. So let's talk about multifamily. Let's talk about the fund that you're currently working with. And I love the mission. Someone comes from a faith background. I particularly love what kind of is driving them. So let's talk about what you're working on, this current project, and why you think it's so interesting and why you decided to partner with them.
Yeah, so it's interesting, right? I've closed or pending close on a couple multifamily deals, some single individual deals, a deal here in Denver, another deal working on, out of state. And one of the things that's great is like when you're working on different deals, you start understanding what investors are looking for. And one of the big things, obviously people are looking for great returns, but they're looking to like make a difference and impact. And so when I, was talking with my now partner on this deal, he is a person that, had a relationship with the operators behind this. And what's cool about it is that this group of guys were on the board of this nonprofit, and they were trying to answer the question, how can we permanently fund the work of this nonprofit and continue to support the impact that they're doing in the community? And they happen to all be kind of ultra successful in multifamily, and that was their expertise. So of course the answer they came up with was, let's launch a fund to go acquire 6,000 units, across a few different specific markets, and then let's turn that into a publicly traded REIT and make the nonprofit a partner in the deal so that they're receiving upside, the promote from the general partnership, as well as being able to continue to hold on to those assets and receive the upside on that for a long term, and be able to execute this strategy that the nonprofit does within the community. And essentially what they do is they go into these apartment buildings and they build relationships between residents. And what really stuck out to me was, You know, I'm a person, I live solo. I've lived solo. I've worked solo for a long time. COVID's been a tough time. And when you look at the numbers, over 70% of people in America today answer the question to a Times, poll that they're always or almost always lonely right now. 70%.
Is it that high of a stat?
70% males more than females, but they're really close for both genders.
Wow.
And it was up from 50% pre-COVID. So this is not a new issue, but it's a worst one. And so to me, the whole mission behind this group is that they really believe in a set of values of treating other people like family, really kind of living by this idea of we're going to treat people really well. So much so that they might ask the question, why are you doing this? And that opens up some different conversations they can have. But at the core, to me, it was all about community and it was all about impact. And then when I look deeper, the team behind it has over 1 million units that they own collectively and over $100 billion of assets. So to me, what that says, it's an incredibly
Those are large numbers.
team. It's the most experienced team I've ever seen. And they're coming together not to make money. They're definitely going to. This is going to be a successful project the way that I'm looking at it and for my projections. But what excites me about it is that they're coming together for a purpose and a mission. And so when you can kind of combine impact with income, and there's really solid returns within here, but that impact piece makes it different. You know, we always hear about deals and people are always talking about the IRR or the annual return. But when you can kind of go and do something that's going to directly challenge and build friendships within communities to tackle this loneliness epidemic, to me, that just sung out, this is huge. And I want to figure out a way to be a part of it. And so that's the reason why I decided to join.
And two things that really stuck out to me, because, we talked about, we prepared for the show a week or two ago, Steven. You sent us the slide deck you had. So it was that aspect, the community aspect in apartment buildings, but plus was a way that this fund is adding value. It's not the traditional way of value of, hey, this place is, mismanaged, under rented, it's renovated 20 years ago. It's more of a, what you just call a data-driven, online review-driven. I'm probably butchering the word there, but can you talk about that for a minute? Because that was fascinating to me. And it was also just like, oh, that's also so simple.
Yeah.
Talk about that, please.
Yeah, I mean, there's so many different ways to add value when you buy apartment buildings. And we always talk about wanting to focus on cash flow first over appreciation. There's opportunities to go and do heavy appreciation deals where we force appreciation. That's like a flip or a development deal. We like those kind of deals because they typically have an opportunity for really high returns, but they often don't have cash flow. And there can be some risk that happens during that process of executing that business plan. Is the construction to go as planned? Are challenges going to come up along the way? Of course, right? These things are going to happen. But what's interesting about this is because this team has so much experience, because of the background of a number of the members, including one of them working for a company named RealPage, and they are essentially a data analytics platform that's required to be used by REITs, real estate investment trusts, and the pensions, because it gives this really detailed view into what's happening at the property level on an hour-by-hour basis and some other cool technology things. The whole strategy here is actually to go purchase properties that are already renovated or newer properties, 90s or newer, that already have all that renovation done. So you've eliminated the risk of executing a renovation plan in all these different markets that they're looking at. So the idea is try to minimize risk as much as possible, buy properties through a fund so we can get either market price or better than market price, not deal with competing on the market because of the relationships that the team has, being able to reach directly into all of these owners, through all the brokers and having all these personal direct conversations. But the value add really comes from the fact that they're going to execute looking for properties that specifically have low resident happiness scores or low ratings or reviews, if you want to just simplify it. And so why that matters is because apartment life, just by coming in and doing community events, it blew me away that it makes this big of a difference, but they've done multiple studies on it. And by doing these community events and building friendships between other people in the community, it's something like 49% of people in apartments right now do not have any friends within their 200 or 400 unit building. And just by coming out and doing this, that number moves up to 67% of people have some relationship with other people in the building.
So from 49 to 67%?
It's a flip the other direction.
Wow.
And so what's cool about that is that when people are living in community, in a society, in an area where they know other people, where they have their friends, where they want to hang out, they're more likely to stay right there. It's the same reason why oftentimes it's hard for people to move across the country, but it's on a micro level where it's your neighbor's your friend and you got a friend down the street and people treat you well and it feels really good to be there. They're able to actually increase rent as a result, and they're able to decrease the number of essentially resident retention. People leave less often, both on the employee side as well as the residents. And so that adds a ton of value. And then when they execute some of this technology, that is planned to add anywhere between 8% all the way up to like 25% of return just by going in, spending 15 grand on some software, executing a strategy based on building relationships with other people, and using this technology to improve that asset overall.
So that's 15 grand per unit on the software?
Per building.
Because this is the interesting thing. Like a lot of times, it's 10 to 15 grand per unit. You're talking about a lot lower value
$100 or less a unit. Yeah. I mean, one of the biggest expenses we have, we have 600 or 700 units between Denver and Des Moines, is just the turnover. When tenants leave, I don't really believe in carpet, as most people know, but like one of the biggest expenses is you got to paint it. Sometimes you have to patch and drywall. You're doing new countertops. You're replacing tile, your fixtures, plumbing, whatever, several $1,000s every turn. So if you can lower turnover by that margin, I mean, that's massive dollars to the bottom line, right? If people are staying in units, you're not having to do turnover, you're not having vacancy, you're not having delinquency, if they're good tenants. So that's reading through this, I thought that was one of the most interesting things, is if you can create more community where people want to stay, they feel tied in, they feel like they're bought in, invested in that complex due to the relationships they've built. You're not only doing something really good for the people and their lives and their fulfillment, but you're doing something great for your partners, your financial partners. So I love that. Provided this data is correct, I mean, I think that's like a massive value add to the entire project. Yeah, I mean, just the nonprofit partner and what they do, they've done a study, and on average, they're adding $188,000 a year in saved expenses or increased from
revenue.
Turnover.
Specifically to the bottom line of the property. And when you're talking about a 5 cap, right, a 5% cap rate, and you look at that for every, roughly, right, guys, $1 saved or earned at a 5 cap adds $20 to the bottom line. That is huge when you're talking about saving or adding $188,000. So it's huge increase to the value of the property. Obviously, saving on expenses is really big, but this whole philosophy is all about buying properties, doing extremely low risk. If they spend the $15,000 and didn't add any value, they still have a great property that's still cash flowing and bringing in, really solid cash flow. But of course, the strategies work. That's why they're going to execute them. It's a proven process. But it really comes down to essentially buying great properties and then operating them better than most people do. And they're able to squeeze a lot out of it. But the cool thing is, we kind of mentioned this at the beginning, the whole strategy, and it's not built into the pro forma, meaning what's important to understand is what's in the pro forma and what's not. Because when you're investing in a multifamily deal, sometimes an operator is going to be really aggressive and they're going to include everything they possibly could think of and try to really make that number look high. So you go into it feeling like, yeah, this is going to be a home run. Versus experienced operators know it's better to underpromise and overdeliver, right? We hear some really big names in this space that talk all the time about cash flow, and they're really big on YouTube and all the plays. And they always talk about overpromise and maybe overdeliver, right? But the idea of underpromising and overdeliver is huge. And so the numbers are conservative, but what's cool is the whole plan of this strategy is actually to go purchase, all these units, 15 to 25 buildings, 6,000 units, and turn that into a publicly traded REIT. And so there's a lot there, and most people, even in my space, in the syndication space, don't deal at this kind of level of deals. But there's a huge upside when you take something from the private market where there's no liquidity, where you're locked into the deal for 5 years, you've committed to it. That's awesome because you're going to earn a higher return. But then turning that into the public market where anybody can buy in, it ends up really increasing the return dramatically when that happens, assuming that it happens.
So I want to ask you this question from like two angles. It's more about the business plan approach. One for you as someone helping to put this deal together, and the other is just for like people investing in the fund. Because you mentioned some very big numbers, and I don't want to mention any names on the slide deck just because to keep it private for you, but I mean, there are some very big names associated with this fund with some very big numbers. And obviously they're taking institutional money with the end goal of taking it to a public REIT. So from, you as an operator helping them put this deal together, what's your business plan there, and how can you give advice for people wanting to like, oh my gosh, this is a unique plan. How can I do what Steven is doing? That's my part one.
This is such a good question. I'm glad because sometimes when you're in it, you kind of forget about some of the things that most people don't really understand how this works. So when it comes to syndication, there's a lot of different ways that you can put together a deal, but oftentimes it'll be a single deal, and you're going to raise capital for that single deal, and you're going to partner on that single deal as a general partner. Another way that you could do that is you could raise a fund of funds, which is I'm going to raise funds, and those funds are going to go invest either into a single deal with a single operator, or maybe I'm going to spread that money out based on my experience and expertise into multiple deals, creating diversification. So those are two common ways to do a deal like this. And for me, again, back to the whole partnering with experts, bringing something to the table that adds value to them and making it kind of a no-brainer. In this deal in particular, what's really cool about it is that the deal is really designed for institutional investors. It's designed for people who are high net worth individuals who are going to cut a check for $1 million or more. The minimum to invest in the deal is $1 million. There's large institutional money from name brand companies that you know about who are writing checks in the $5 to $10 to $15 million. It's going to be a fund that's going to be enormous, right? Hundreds of millions of dollars will be raised for the fund. But so what we did here is we put together a fund of funds. And so with this, we essentially will go raise money, up to $5 million for this example. We're going to go raise money, and we're going to then invest all of the funds, all of that money directly into this operator as a limited partner. And so the cool thing about that is that everyone who gets to invest with us in this deal would then be directly in the deal with the operator, essentially earning similar returns to what they would earn if they were working with the operator directly. But we've essentially added another layer so that we're the ones who are answering the questions. We're the ones who have to send out the reports. We're the ones who have to, send out the K1s and do all of the work. And so it's super value add to the team behind it, because this is great. More money into the deal means more opportunity to make a bigger impact faster. That's a win. And they don't have to deal with this. And then we create an opportunity for us to be able to, not only after doing all the work to earn some of the upside, because we're paid out on the back end based on the success of the deal. And then there's some fees in there to cover, all the attorney fees and all the things like that on a day-to-day basis. But essentially, just summarizing it, we've created this vehicle for people to invest into, and then we write one big check so that we can meet the minimum and invest with them. And then as a bonus, one of the important things here for us was that we were able to negotiate a better set of terms, so that we were able to essentially get paid based on the better set of terms. So in other words, our big check that we're going to write is going to receive more of the upside than just a normal investor writing that check. And the benefit, right, is that we're able to then pass that along to the fund, and then we're able to take our return out of the back end again.
And so my part to this question, because that was a phenomenal answer, and I actually want to ask you more questions about that. But to finish up my first question, so for a retail investor, let's say, hey, I like this, Steven. I'm going to write you a $100,000 check to invest in your fund, to go in the bigger fund. What's the business plan on the back end for someone like me? Or can you share those details? Just at least a high level kind of like breakdown, because a lot of people know like, hey, invest in a one deal syndication. How's that compared to investing in like a fund of funds like you're putting together?
Yeah, really good question. And it's an important question to understand, right? And this is an example of a kind of deal you could invest in. This deal in particular is available only to accredited investors. And one thing you'll learn is that if somebody's talking about a deal in a public space and that deal is still available, then it's probably only for accredited investors. Mm-hmm. There's a reason for that. The SEC has certain rules and regulations around this, and this deal is only for accredited. And we're not making an offer for this deal, but if you were going to invest in a deal like this, the way that it would work out is there typically would be some kind of split, and there would typically be some kind of fees. right? Some kind of fee for putting the deal together and some kind of fee for continuing to operate the entity, the business. Because essentially what we've done is we've set up a business, an LLC, we put together an operating agreement, and then we put together what's called a private placement memorandum. It's a really long version of an operating agreement that has all of the risks involved and is required by the SEC to include something like this, because it essentially says all of the things about how you can lose all of your money and everything could go not as planned. And that's required, right? Any deal that you're going to invest in is going to have something like that if you're investing on a large scale. And so an investor within that PPM or within the offer memorandum, usually within both, because the PPM's essentially like a long legal doc, hundreds of pages. Sometimes it's as short as 50. But within it, it's going to talk about what these terms look like. And so on this deal in particular, it's a 2% capital placement fee. So 2% of the money that goes into the fund immediately is paid to the fund managers to cover the costs of legal and, searching and accounting and all these things that have to be done up front, because it costs tens of thousands of dollars to put together a PPM and to put together this whole vehicle for people to invest in. So that 2% capital placement fee, and then there is often a management fee. It's a fee that comes out on a yearly or monthly basis. That typically ranges anywhere from like 1% up to 2%, depending on the deal. And it's important to understand what that percentage is of. But in this case, it's a 0.75% fee. And that again goes to covering accounting and sending out all the reports and all the things that are going to happen over the 5 to 7 year life of this fund. So, there's a lot that's going to have to happen after the money is placed in the deal. And then what the investors end up looking at, the thing that's important to an investor is how much of the upside am I going to get paid? So the way this one is structured is there can sometimes be a preferred return, and that means you're going to get paid a specific number before the operator gets their split of the upside.
Okay.
And on this one, there's no preferred return. Because there's a preferred return from the deal itself, from the operator coming into the fund, there's a preferred return built in. We don't have a preferred return on this deal, but there's an 80-20 split, meaning 80% of the upside goes to the investor and 20% of the upside goes to the operator. So the way that really works is almost none of the money, this is an important fact I almost forgot. And built into that, there can be different ways that you pay down the amount of that original investment. In this deal, all of the money goes to paying down the original investment. So it's, return of capital.
Okay.
So every time there's a check written, every time there's cash flow, it's returning that capital. It's paying down the amount that person had invested. They still have the same number of shares. They're still entitled to all the same, but we're just essentially paying them back their original investment. And then after that, there's an 80-20 split. And so because of that return of capital, because the operators won't get paid any of their split until the deal is sold or the deal goes public, we did an 80-20 split. And what's nice about that as an investor is you think about it, all you did was write a check and then you sat back and you collect 80% of the upside. It's pretty rare that you're going to see something like that. And then because we built in the better terms, then you'd go directly. It actually increases the upside, increases what that return would be to the investor.
Okay. And I want to ask one more question on here, if we can dive in this, because I started asking this before we hit record on here, and you had mentioned, I'm not sure it was before or while recording now, that one of the exit strategies is that this fund will go towards a public REIT. And you talked about that there's the public REIT bump, for lack of better words. Mm-hmm. Explain that again to me and the audience. I found this fascinating. I know very little about REITs other than, hey, I know what they are, but I don't know the details of them. So what does that public REIT bump look like potentially for you and your investors?
Well, so it's important to know kind of like why it happens, like where the money comes from, why there's kind of a premium for going to the public market.
Yeah.
And so I'll kind of explain that, and then I'll explain kind of like what we're hoping could happen. But we haven't included in the details of the deal specifically because trying to be as conservative as possible. If something's not as close to something that we really believe is 100% going to be the way it's going to go, then we don't want to include it in the projections. Of course, they're projections, but we want to be as conservative as possible. So the deal is when you are working in real estate, you have an opportunity to invest in a publicly traded REIT. You can go do that today. The REIT is something that you go to the stock market, it's essentially a publicly traded security. You can buy in at any time. The advantage is that you can sell at any time, right? You have that liquidity, but it also moves with the market, right? So when the stock market goes up, REITs will go up. When the stock market goes down, REITs will go down. It moves quite a bit. So there's a lot of volatility. So with a private deal, you're usually getting a higher rate of return. There's a premium that you're earning based on having less liquidity. Oftentimes on these syndications, you might sign a document. The expectation is that the project might take 3 years, maybe 5 years, maybe 7. And, some deals are 10 or, really long-term deals. So you don't have liquidity during that period, meaning you're not getting your money back. You can't just come to the ATM and say, hey, I want to get, I actually want my $50,000 or $1 million back. Now, oftentimes there's built-in, ways that you can take your capital out early, or special circumstances that people can do that, but all of the details are always different per deal. And so you actually earn more money because of having less liquidity. So the deal is that once you have enough assets to go public, enough money coming in, enough cash flow to make it worth it, to do all of the filings, to go through all of the legal process, to be able to be listed on the stock exchange, very costly process. You want to make sure you're big enough. And when you go through that process, what ends up happening is you have to think about, where is the difference between something that's privately traded, or in this case, it's not a traded asset, so you can't trade this product, a private placement, and a publicly traded REIT. Well, there's a difference between the returns between the two. So if you're the person who starts here and you're earning this return, and someone is willing to pay way more, meaning they're earning less, right? They're paying more, they're earning less. As this fund would, theoretically would go public, they're willing to pay more. So they're buying up the value of the shares. And just like a stock going up because people are willing to buy into it because they believe in what's going on, your share value goes up. And so, it depends on the REIT, but on average, they usually say that it will add about 10% to the internal rate of return, right? The average annual return is different than internal rate of return. IRR is based on when you receive the money. It's more of a true idea of that return versus an annual return might be really high, but you don't get paid until the very end. It depends. People use different numbers, but adding, on average 10% to the return, the IRR, potentially more, potentially less, makes a pretty big difference, because that public market wants that cash flow and is willing to pay way more for it than you originally bought in at. So therefore your shares go up.
You mean a 10% to the overall IRR?
Yeah. So let's say
that could be a huge bump.
Yeah. I mean, let's say the deal was kicking off a 14% IRR, and they were super conservative. And, let's say they projected it was going to be 14%, but it actually ends up being 19, or maybe it's a home run and it's 20. And then you add another 10%, now you're at 30% IRR. That's huge, right?
That's insane.
Yeah.
You don't see those IRRs.
You don't see those, and you definitely don't see those on stabilized deals where you're looking at things from, hey, how can I have the lowest amount of risk in comparison with the kind of return that I'm receiving?
Yeah. This is all new to me. This is fascinating.
No, yeah, it was a fantastic summary. So
great job explaining it, by the way,
yeah,
Steven.
This was great. You could teach a class on that, and maybe you should look into that. So the Tribe of Multifamily Mentors podcast. Steven Pesavento here. He runs one of the best podcasts regarding mindset and real estate called The Investor Mindset. It's been ranked, I think, in the top 200 on Apple. I mean, you've had incredible accolades there. So Steven Pesavento is here in the studio with us. He's talking about his transition from single family to multifamily, investing, direct ownership, syndication, and now a fund of funds. So incredible stuff here. So because it is called the Tribe Multifamily Mentors, let's talk about, real briefly, because we have to wrap up here, who are your mentors? Talk to people about how you've been able to find mentors through your career, and some advice for the audience that maybe is sitting at home, just like you were in 2016, and saying, man, I really want to get into real estate. I'd love to get into multifamily. Where do I start? How do I find some mentors? Your advice.
Yeah, it's a great question, because I really believe in the idea that it's important to find other people who are already succeeding and doing what you're doing or doing what you want to do, and then figure out how can you be around them and learn from them. You can get around them through listening to podcasts. You can get around them through coaching directly with them, through being part of masterminds or other types of events or different ways to connect. And so for me, I've got a ton of mentors because my whole belief and philosophy is let's find really smart people and learn how they think. And then I can just take the way that they think. I can borrow those beliefs. I can take on those ways of thinking and then start, actually having some of that return for me, having some of that actually happen and manifest in the world. It's happening for me right now. The whole reason I'm in real estate and in general is because I went and found some mentors and I found a way to be able to add value to other people. So a couple of ways, definitely go listen to free content. Definitely check out, the podcast here. Continue to listen to the kind of things that are putting out. Obviously, Investor Mindset, great place to check out. But what you can do is once you've gotten, your fill of all of the free stuff, then you start getting into curated education. You start finding other people that are doing that, and it speeds up the process so that you can start really learning without having to go through and sift through all of the information that's on the internet, because there's a million things, and you listen to what they say and you follow their direction. So some of those people for me, Hunter Thompson, great person, love his book, look up to the kind of the businesses he's built. Tony Robbins, somebody that I have learned a lot from, is definitely one of those digital mentors where, you kind of consume the content, you start understanding how they think. Tim Ferriss, love the community that Joe Fairless has built with the event, Best Ever Conference. There's tons of people within the space. Terrence, you're a mentor. You're somebody that I look up to. Chris, in different ways in the marketing space and what you've been able to create, looking up to you. And so there's mentors all around you. There's mentors everywhere you look. And once you get clear on what you want to do and why you want to do it, and you make that decision that you're going to go forward and do it, you start letting people know, hey, this is the direction I want to be. And you might notice that there's somebody right there the whole time that could be that person who could direct you in the right way. And the cool thing is, once you realize that, you can be that person too.
Yeah, I love it. I mean, I really admire the way you've built your business the last couple of years and how you've been surrounded by incredible people. I mean, some of the people in your Rolodex, the people you've had on your podcast, the people you consider friends and mentors, I'm just like blown away by some of the people in your network. So definitely, if you're listening and you're looking to grow, listen to what Steve said, really take it to heart and take action. Take action on the fundamental principles that he just discussed. The last question I have, something the three of us have discussed, I think at this very table several months ago, superpower. So I'd love to hear, we talked about your strengths earlier. What do you think is your superpower? What separates you from everyone else?
I think my superpower, without a doubt, is my ability to understand complex topics and simplify them down and speak really clearly in a way that makes it really easy for people to understand them and to be able to then take that understanding and do something with it. Hopefully that's making a decision, but through that process of being able to take these ideas and simplify it so people feel like, well, this stuff's really basic. I'm really glad that I heard that, when in reality, some of it's really complex. I feel like that's something that I'm excited about it because I know the value of learning, and it's really exciting to be able to share that with other people. It's something that really fills me up.
Yeah, if anyone's doubting that that's a superpower, just go back and listen to his explanation and summary on the REIT, and I think you'll be convinced that is his superpower.
Yeah,
I thought that was phenomenal. Yeah, I thought that was phenomenal.
That,
I think
any vocabulary for
people that work on Wall Street, I don't think can articulate it as well as you just did. So I love that. I think you have several superpowers. Me personally, I think that your ability to understand marketing and people's instincts and the way they're going to make decisions, and just your ability to articulate and communicate, definitely a superpower. You're a 10 out of 10. You're high. You're elite at that. I've loved getting to know you. I've loved this conversation, and super pumped for this episode and this show to come out, and for other people to be able to listen to your story and some of the valuable insights you have through building your career from single family to multifamily, from investing in syndication, now in a fund of funds, looking to do $1 billion in assets here in the United States and in the Sun Belt. So I've learned a lot from you. I've constantly challenged by the things you're working on. So I've loved it. And I'm hoping people can really get a lot out of the things you said.
Yeah. Thanks so much, Steven. This has been great.
Man, it's been super fun being here, and thanks you guys for taking the time to listen. It's always fun to be able to share this stuff, but I really believe that it's only worth learning something if you're going to take one nugget and take some action on it. What's the one thing you can take away from this conversation? Maybe it's going and figuring out what your superpower is. Maybe it's understanding who you're going to reach out to or who you can share something with and going out and doing that. And if you happen to be somebody who has a skill set that I talked about, I highly encourage you to reach out to me and to connect. I make myself accessible, even though I definitely don't have a ton of time. And if you're somebody who is looking to kind of take a next step, continue to watch these guys because they're on the come up and there's some really good stuff coming down from the tribe of multifamily mentors.
How do people get in touch with you?
I'd say the best way you can find Investor Mindset on YouTube. You can find it on podcasts. Definitely check that out. Dive into some of the content we have there. If you're looking to contact me directly, direct message on LinkedIn, Instagram, just hit me up directly. I'm the person who's responding, or somebody will help get you scheduled or to be able to take a next step. But remember, if you're going to reach out to anybody, you got to make sure that you're coming with value. So think about that ahead of time.
Ooh, I'm glad you went on that. That is a great point to end on. All right, Steven Pesavento, this has been great, man. Thank you so much.
That was awesome. Well done, Chris. Boom.
You're listening to the Multifamily Mentor Show.
Join the conversation.